Welcome to Outside the Dollar. I'm Elena Reyes. CBS News reported employers cut 23,000 jobs in July when economists were forecasting a gain of 95,000. At the same time, Morningstar says inflation is still sitting above the Fed's target with fresh data due this week. And gold just posted its best week since February, while Fox News found nearly half of central banks plan to keep adding reserves. So which signal do you trust? A cooling labor market, sticky prices, or metal that's moving like something's off? We'll dig into what the jobs miss might mean for your money, why gold's spike has central banks and retail investors reading from different scripts, and what a bigger reserve number out of Beijing could say about the dollar down the road. Let's start with the economy because that's where the tension began this week. Two numbers came out this week that don't want to sit in the same sentence together. Friday, CBS News reported the U.S. economy lost 23,000 jobs in July. Economists polled by FactSet expected employers to add 95,000. That's not a miss. That's a swing of well over 100,000 jobs from what was forecast. And CBS noted May and June got revised down too, a combined 103,000 jobs erased from what we thought we already knew. Local government education lost 50,000 positions. Retail shed another 19,000. Healthcare, usually the sector propping up the whole report, wasn't enough to offset it. So naturally, you'd think slowing job market, cooling economy, maybe the Fed gets some room to breathe on inflation. Except Monday, Morningstar previewed July CPI, and economists aren't expecting relief. They're forecasting prices rose 0.1% for the month, 3.4% year over year. 3.4. The Fed's target is 2. Morningstar's read is that June's dip was more of a blip than a trend, tied partly to gas prices earlier in the month. That's the harder read here. Softer hiring doesn't make inflation disappear on its own. And markets noticed something else this week. Gold just had its best week since February. Central banks are buying too. A survey Fox News covered Monday found a record 45% say they plan to add to reserves. Now, did the jobs report cause the gold move? Did the CPI forecast? I'm not going to tell you it's that clean. What I can tell you is the timing. Weak jobs, sticky inflation forecast, and gold moving hard all inside the same week. So which is it? A slowdown markets are pricing in, or a quiet reassessment of what a dollar is actually worth? Building on that gold number, let's actually look at what moved. Yahoo Finance's chart of the day piece has gold up nearly 7% for the week, a 7-week high. Wednesday alone, a 4% jump, the biggest single-day move since February. Yahoo Finance notes analysts are asking whether the earlier pullback, the one that cooled prices for weeks, is starting to reverse. Here's what I won't do: tell you the jobs miss or the sticky CPI print caused this rally. Nobody can draw that line cleanly this week, and the Yahoo Finance piece doesn't try to either. Timing overlap isn't a mechanism. What actually interests me is the mismatch in horizon. Retail traders are reacting to 7 days of price action. Central banks, separately, are making allocation calls that play out over years, not weeks. Different clock, different game. So which one should move your thinking? A hot week or a slow institutional shift you barely notice until it's already reshaped reserves? Because there's a fresh survey on exactly how many central banks are planning to add gold, and the number isn't small. Hold that thought. Building on that reserve question, Fox News just published survey numbers worth sitting with. A record 45% of central banks surveyed said they plan to add to their own gold reserves over the next year, and 89% expect total global central bank gold holdings to rise, whether they're personally buying or not. That's not a fringe view anymore. That's most of the room. Here's the part that gets people's attention. 74% of those same central banks expect the dollar's share of global reserves to be lower 5 years from now than it is today. Let's be precise about what that is and isn't. The dollar is still, by a wide margin, the dominant reserve currency on Earth. Nothing in this survey changes that today. What it captures is a direction of travel, a slow, deliberate rebalancing, not a stampede. And China is part of that story. Reuters reported China added to its reported gold reserves again in July, the largest monthly addition since October 2023. When I sit across from a household, their time horizon is maybe retirement, maybe a decade, maybe more. A central bank's mandate is different. They're managing sovereign reserves against currency risk, sanctions risk, decades-long geopolitical exposure. A pension fund doesn't think that way. A country does. So when 45% of central banks say they're buying, that's an institutional signal, a completely different set of incentives making a completely different kind of bet. Now, flip that on its head. If institutions with the longest time horizons on the planet are quietly reducing dollar concentration, even while it stays dominant, what does that say about how they view the dollar's purchasing power 20 years out? I don't have a clean answer for you, but Japan's currency defense this year gives us a much more concrete, almost mechanical look at what happens when a major holder of dollar assets gets forced to act fast instead of slow. From central bank surveys to an actual currency defense, Japan's yen just gave us a live example. The yen weakened to its lowest level against the dollar in roughly 40 years, and Washington stepped in alongside Tokyo to prop it up. That's notable. The U.S. rarely joins these interventions. Japan held about $1.14 trillion in U.S. treasuries as of the end of May. When a country defends its currency, it typically sells reserve assets, treasuries in this case, to buy its own currency back. But selling that much debt into the market can push U.S. interest rates higher, right when the Fed is already juggling a weak jobs report and inflation still running hot. So what's the alternative to dumping treasuries outright? U.S. officials have backed the Fed's FEMA repo facility. It lets foreign central banks swap treasuries for dollars temporarily, a short-term loan against the collateral, instead of selling into the open market. It solves a real problem. Defend your currency without crashing your own bond holdings or spiking American rates. Economist Barry Egan-Green has posed a question worth considering. Can a currency stay dominant if the countries holding it the most start hedging their bets? A June 2026 survey found more central banks expect to reduce dollar holdings over the next decade than plan to increase them, and the shift shows up in the numbers already. ECB data puts gold at roughly 27% of global reserves at the end of 2025 versus 22% for treasuries. Still, physical gold isn't anyone's IOU. It's not a promise to repay. None of this means the dollar's dominant role ends tomorrow. But if institutions managing trillions are asking these questions about their own reserves, what does that mean for how the rest of us think about ours? Building on that, let's pull the week together. 4 things happened. Hiring came in weaker than forecast. Inflation is expected to stay above the Fed's target. Japan is defending its currency while sitting on well over $1 trillion in treasuries, and central banks worldwide are quietly building gold reserves. None of those 4 things caused each other. They're separate signals pointing in roughly the same direction this week. The honest question isn't whether households should copy central banks. Nobody's suggesting you run your finances like the People's Bank of China. It's whether it's worth understanding why institutions with decades-long time horizons keep choosing gold and silver for their reserves. It's a line of research long-term investors quietly build into their own plans too, alongside stocks and bonds. Gold pays no interest, and it's rallied hard before only to stall for years. What ties the whole week together? The jobs miss, the inflation forecast, Japan's currency defense, the reserve shift, is one underlying question about what a dollar is worth over time. So here's what I'd leave you with. Forget whether gold hits some target number this year. How much of what you own depends on a currency holding its value, and how much doesn't? So that's the week. Soft hiring, inflation still running above target, and gold posting its strongest stretch since February, while central banks keep adding to reserves. Maybe the question worth sitting with is why some investors treat physical gold and silver as one part of a broader, long-term strategy. Speaking of gold and silver, Lear Capital's offering 20% off silver American Eagles right now, tax and shipping covered, a full troy ounce of 0.999 fine silver, backed by more than $3 billion in trusted transactions. And I can tell you, getting silver below spot doesn't happen often. So text $dollar to 43343 to learn more and lock in this price before they're gone. Again, text $dollar to 43343 to secure your silver American Eagle below spot. Thanks for listening. See you next week.